Hey, what's up everybody? Welcome back to the channel. So I'm doing something a little different this time. We're filming from my office / workout room / guest bedroom whenever we get a bed in here, but right now it doesn't have a bed, so it's not a guest bedroom yet. So really I just use this as my office and a room to work out in. Anyway, I wanted to talk to you guys about something a little different still. That's why we're in here. So I just refinanced my car. Now I know I made a video before about financing a car. It wasn't very popular. The people that did watch it were like saying that financing a car is dumb and comment. I mean, I don't know who those people are, and if you have $10,000, $20,000, $30,000 to go drop cash on a car, congratulations, you should do that. You know, it is cheaper in the long run than financing, but for the average Joe like me and Bob down the street or whatever, you know, that's just not realistic. So anyway, yeah, I financed my car when I bought it. I financed the car before that, and I think the car before that, and then before that I bought cars in cash, but they were cheap cars. They were kind of junky cars. It is a good way. So let's go ahead and talk about refinancing the car, why I did that, and how it saved me money. So I'm a believer if you finance a car, you should get it for the longest term possible so your monthly payment is the lowest, and pay extra. That's, so say you have a 3-year payment and it was to be like $600 a month maybe or something. I don't know what kind of car it is, how much, you know, but let's just say that. But say you did it for 6 years and it was like $320 or whatever, you know, a month. I would go with that one and then pay extra, you know, pay what you can afford. That way if, you know, something bad happens or whatever, you know, you're not obligated to pay the maximum. And, you know, so I took a 4-year loan on it, and I think it was about $11,000. So yeah, I really didn't have a down payment. I just got out from underneath the old car scot-free and started over again, which was, in retrospect, dumb. So if you want to comment saying that was dumb, go ahead. It was. I should have saved up more money before I went and did it, but the 328 had problems. It was going to cost a bit of money to repair it, so I just wanted to get rid of it instead of spending the money to fix the car. Just put it into a new car. Probably wasn't the smartest thing because I wound up having to sink like $1,000 into the 335 immediately. But anyway, let's talk about the financing thing because that's what I want to talk about. So I'm going to use specific numbers because I want to give you guys a real-world example and show you how a small change in an interest rate can make a difference. Maybe not a huge difference, but a good solid difference on your monthly payment. So I financed at 5.25% when I first got the car. You know, the rate on my old car was 4.5%. Rates had gone up during that time. I'm a bit of a finance guy, so long story short is Fed sets an overnight interest rate. Federal Reserve Bank or Bank of England or whatever country you're in, your central bank sets like an overnight rate. Pretty much all rates are based off that, and then that kind of sets treasury markets, which kind of set lending markets and housing markets and yada yada yada. You get the idea. So the Fed rose rates a bunch in between the two cars. Anyway, rates came back down, and I saw on the credit union's website that they had lowered their rate to 4.5%. So I, you know, called them up and see if I could refinance with them, and they said yeah. So anyway, long story short, I owe $8,800 on the car. So I'm going to do a little cute computations right here. So I already have it put in here. I made an amortization table, and I'm not going to go into the details of how to do that. If you do want to know how to make that, Google. It's really simple. Excel. I'm using Sheets on Apple. I love my MacBook, by the way. Plug Apple, yeah. So anyway, putting that in with an $8,800 balance, my monthly payment was $292 a month. So that was a 4-year finance term, and I had been paying extra every month. I just, you know, every time I got money, I put something to the car. Anyway, but assuming I made the monthly payment as scheduled, my interest payment this month would have been $38.50 of that. So a decent chunk was going to financing, just the carrying cost of owning this car and having the loan. So that kind of, you know, that's money gone. That's money that doesn't go to the car. That's money to the bank. And it's really not what I want to do. Obviously, if you pay extra the further down the road because of compounding interest, because you pay interest on your interest, even if it doesn't really look like that on your statement with these, because it's just the way they make it look, but you pay interest on your interest. If you're interested in that kind of stuff too, I could do videos on that. I could make a whole separate channel about this kind of stuff. If anyone is interested, let me know in the comments. Anyway, and going on down, so this is I only made this up to 17 months, but so after a year, interest would be $26.03. And these numbers are a little off because I did this on a monthly basis and they compound your interest on a daily basis usually. So assuming that we don't change any of that, which I did change my monthly payment because like I said, I believe in taking the longest term available to get the lowest mandatory obligation. I fully intend to pay the $292 I was paying plus some. Anyway, so let's change the number. So let's change nothing and just change it to 4.5%. Under this system, still paying $292, same balance, same everything, just change the rate. And that makes my interest $33. So now you might be saying to yourself, okay, $5.50, okay, is that, but if you do that every month, it's going to be that plus that $5.50, you're going to be paying your 4.5 or your 5.25 or whatever your rate is on top of that payment every month, because that money didn't come off your principal. So you're paying that interest on interest, and that's why they call it compounding interest. So if we take that on down to 12 months, it's at $22.11. So you can basically see you're saving yourself $5.50, and it's decreasing ever so slightly every month how much you save. But if you add all of that together, and that's real money you can do. Basically, if you take 5 times 12, you're going to get, what, 60? So, this is $60 a year, provided everything else stays the same, you make the same payment, you pay it off in the same amount of time, and you save a decent amount of money. Now, if you're paying a higher rate, like say you went from like 8% to a 5% rate or something, I don't know, that your savings would be that much more. I mean, this is a 75 basis point reduction in rate, and that's how much I saved. So, I just wanted to share that because saving money is something that I want every one of you to do, because there's really no sense in spending money you don't have to. And that's what interest is basically it's spending money you don't have to, because I didn't need to buy a BMW or a E90. I could have bought a E36 and bought it in cash, or whatever. But guys, yeah, I just wanted to share this little bit of information. If you guys want to see financial videos, I could do it on this channel. I could make a separate channel. Whatever, I love talking about that kind of stuff, and I think people can learn a lot from it. So let me know in the comments, and thank you for watching. I will see you in the next one.